Okay, hello everyone, and thank you for watching live or in the recorded session. I'm Alessandro Marianantoni. I'm the founder of M Accelerator, an hybrid accelerator incubator program based in Los Angeles, and since around mid-March, also pretty much anywhere else. In fact, over the last few weeks, we moved our in-person training program in Los Angeles. So we moved it online, and we concluded the winter cohort with our participants online with a live streaming pitch event. So we also moved our in-person events that we usually do in downtown Los Angeles online, so that we keep supporting our community. We're still meeting our friends, our founders, investors, and offer these events to other interests and other startup founders, essentially. So we started with these live streaming sessions with our pitch day, which was our first one, and we essentially every Friday maintained this rhythm with streaming other events, and eventually we'll keep doing it every Friday. Clearly, somehow we really liked it, right? So today the topic is about startup pivot, and I'm happy and I welcome our panel. We have investors and founders. I will call them to introduce themselves and talk about a little bit what they do and their background. And I'll start with Scott Matthews, director at Sutter Security Group. So please, Scott, introduce yourself.
Yeah, good afternoon, everybody. As Alessandro said, my name is Scott Matthews. I'm the Director of Investment Banking and Senior Associate at Sutter Securities Group. My primary function at Sutter Securities Group is I run point and due diligence and deal closure for investment banking clients. So anything from general capital raises to M&A and advisory activity. And in the investment fund, I run sourcing and closing of all deals that run through Sutter Capital Management, which is the fund subsidiary of Sutter Securities Group.
Thank you, Scott. I will call Noble Drakoln, managing partner at Drakoln Capital Partners.
Hi, guys. Glad to be here, Alessandro. Yeah, I'm the managing partner of Drakoln Capital Partners, and what we do is we consult startups to kind of navigate startups and those who are probably headed to Series A to kind of navigate how to raise capital in this environment, particularly with so much going on with COVID-19. A lot of people are finding it difficult to find access to the capital to both expand. We know during times of trouble, you have an opportunity to expand and maybe not only survive, but thrive. And we just give people generalized advice on how to develop their company, grow, and find some kind of sense in the madness of what's happening. My background has been in the investment industry for over 25 years, from running hedge funds to brokerage firms. And I really like the more boutique ability to work and interact directly with businesses and to see them flourish from the ground up or from MVP up. So it's been exciting in the last few years.
Thank you, Noble. And I'm calling Cauri Jaye, co-founder at sesh.
Hi, glad to be here, Alessandro. I have 25 years in technology, and I currently run technology and product for sesh. We're an artificial intelligence-based company where we improve communications, especially in a business environment. So what our product does is it reads people's sentiment and state of mind and whether they have comprehended and understood something that's said based on visual and audio cues. And then we can feed that back to people in real time, so that you could be talking to somebody like on this kind of, and see next to all of our heads our state of mind and our understanding of things. So it's kind of EQ on demand. I've been building frontier technology for decades. Everything from gesture-controlled set-top boxes that controls your TV with your hand to augmented and virtual reality for National Geographic, to all kinds of different global systems. So sesh has been around for about a year, and we're changing the way that people communicate.
Great, Cauri, thank you. And the next one in our panel is Moody Karuna, CEO at Rucept, and he actually was in our Investor Day online a few weeks ago. Please, Mudit.
Hi, so I have about 10 years of experience in e-commerce and internet. I was in India. I've been building startups for most of that time. About 2 years I was working, 2.5 years I was working in in one of the biggest startups in India. It's called Paytm, which is a payments company. It's funded by Alibaba and SoftBank. And now what I'm doing is I'm working on a new startup. It's called Rucept. And we enable merchandising for video games. We enable them to sell physical products like T-shirts, bags, shoes, with their characters and different creative assets on them inside their gaming applications to their gamers. So yeah, pretty much all of my career I've worked in e-commerce and I've built startups, and this is my first time being in the US. We are targeting clients in the US, so that's something completely new for me, and that's how I came in touch with M Accelerator, because we're finding ways to understand the market, and we're finding ways to familiarize ourselves with the industry and the market over here in the US.
Thank you, Mudit. Great. And there's another person in our panel. Eventually, David will join us in a few minutes. In the meantime, with me at M Accelerator, from M Accelerator, there's also Hanad. Hanad, I guess you're there. Do you want to introduce yourself as well?
Hi, I'm Hanad. I'm an associate product manager at M Accelerator. I've been working with Alessandro since August, and I'm really happy to be here.
Thank you, Anad, and then thank you everybody for the introduction. So it's a very informal event. I mean, what I would like to do is to ask a few questions, create an interesting discussions, eventually interesting for who's listening, and for us as well. As we all know, and eventually it's probably also the main reason we are doing this event online is because of the pandemic situation, and the business community is definitely under great stress. Last week, actually, we hosted an official from the SBA describing all the programs the U.S. Small Business Organization is providing as a support to the small businesses in the States. So definitely a great concern for everybody. Great concern for what is happening right now to our small businesses, our startups, what will happen in the next few months, right? So my question for the panel is it time to pivot right now? And perhaps, I mean, for some of you, the answer could be so obvious that it's not even a good question, right? Or and there are so many aspects. There are so many aspects, so many different points of view. We have three investors in the panel, two investors in the panel, and two founders. So definitely different points of view. And what I would like you to articulate in your answers are your specific point of view, and which are the elements that you were able to identify before considering pivoting, or while you were considering pivoting, or not necessarily pivoting, but adjusting your business, or your decisions mainly for the investors, right? Your decisions for what to do next, what to do right now. And this is a question also for the investors and for the founders, of course. And I would like to start with Scott Matthews, if you like to take the microphone.
Yeah, sure. I think the answer to that question, in my point of view, is it really all depends. It really depends on how strong your balance sheet is in these trying times and what your monthly burn rate looks like. So if you've got enough cash on your balance sheet to really sustain the next 6 to 12 months, and you've proven out product market fit currently, the answer is probably not. But on the other hand, if you're looking at other key performance indicators that kind of drive your business, and you start to see your churn rate really spike, and you're burning through cash pretty quickly in marketing and trying to retain new customers to get your cash flow back to the state that it was in before, that really should spark a couple questions of, is my business or product really durable in market downturns, and is it a really essential business that my users really need to solve a problem? If the answer is no in that case, you should definitely start to consider the landscape that you're in and start to pivot your business model into what makes sense for you. But really, I think it's really keeping a pulse on your cash flow statement and really keeping a very tight eye on your cash position, as well as a lot of your user metrics.
Great answer. Definitely great elements to be considering. I mean, Noble, would you like to mention your point of view about?
Yeah, I mean, so right now we're working with about 7 or 8 different, about 8 different startups now. We just brought on another company, and each one of them has had to do a slightly different pivot to kind of weather the storm. And it's interesting. One of the groups we brought on is an Australian kind of sun and sand business. They have an orthopedic sandal, and because of this whole COVID-19 scenario in Australia, they've been shut out from really selling their product. And so the big pivot for them was to bring on relationships in the US to try and catch the wave before the whole order, or however this rolls out, where people are no longer being forced to stay at home, and catch our summer season. And this is going to be a plan maybe to do next year, but they've upped the timeline to be aggressive and trying to take advantage of it now. And so we're importing, several large containers into the States. They have a new sales team that's kind of getting them geared up. And so I like what Scott was saying about the balance sheet, how important it is to have a balance sheet. I think it also is key to be willing to change your course enough so that you can kind of catch what the current wave is as opposed to just following your old business model lockstep. Because no matter what your key performance indicators are, your KPI, I think a lot of people, they probably have realized by now that nothing is normal in our scenario, that you can't try and hold on to what you thought last year your basic rollouts were going to be. We had also another client of ours, which I'm also an investor in, so just full disclosure, and they were doing an endocannabinoid test that focused on being able to determine if someone's body was exposed to CBDs or THCs. Well, part of the pivoting is now, instead of just focusing on the acquisition of a laboratory that focuses on that particular array, we found a lab that does actually coronavirus testing. And we're looking at retooling now for COVID-19 to be able to be on the forefront when testing becomes more normalized and more regular everywhere. And so I think that the beauty of the startup pivot is the ability to take exactly what you have and then find where the opportunity is for the moment and be nimble enough to just kind of shift gears slightly. They haven't gotten rid of the endocannabinoid test, but it makes sense in this environment that when COVID-19 becomes a normalized, consistent testing that happens, to own a laboratory that does that type of testing. I mean, already only 230,000 labs exist across the United States that does something like 13 billion tests from blood to all kind of bodily tests, and that's not going to change. So this COVID-19 us acquiring this particular machine is going to be great. So I think that for the most part, the beauty of being a startup and part of the pivot is to continuously use your ability to think outside the box and then take your resources that you have right now to apply them to what's actually happening in front of you. You know, my background has always been in trading and sales, and I traded for a long time. One of the things I used to always tell people is don't trade what you think the chart's going to be, trade what's happening right in front of you on the chart. And that'll give you all the indication you need on whether you should be going long, short, or putting on protection or protective stops, or whatever the case may be. It's so easy to think what things should be and really ignore what things are happening right now, what things are. And so I think as a startup, just from my pure perspective, is that just pay attention to what's happening now and then focus on how you can be a part of the ecosystem now as things evolve. I love AR, VR. You know, we have a patent on augmented reality that I filed. We're doubling down on that right now and talking to all of our relationships in the volumetric AR space because, you know, things are changing. People are not going to be going to set and traveling, but that doesn't mean filming is going to stop. And films are going to stop. So by creating a volumetric warehouse of AR assets that can be placed anywhere, that allows us to be a part of that curve. So like I said, all I can say is this for my idea is that the beauty of startups is that we're not entrenched, and that the idea of pivoting should let you look at the landscape and constantly be looking for the diamonds, right? Finding where the opportunities are, no matter what the macroeconomics looks like. There's a bunch of microeconomic opportunities.
So that great novel. So looking at what is happening now, essentially, and that in a way, if I may rephrase what you said, something like the pivoting, it's in the intrinsic nature of early stage startups. And so please, Cauri.
If it isn't, then you shouldn't really be a startup, I think. Yeah.
I would agree with that. I'd like to build on what Scott was saying about budget and KPIs, and on what Noble was saying, identified in terms of trends being the things that move you forward. I think another thing that informs pivoting has to do with the nature of your product. And I can give a very real example of what Sesh is. So Sesh was designed originally to be in two phases over our first year. The first phase was data gathering. And then the second phase was actually building out the artificial intelligence. You need very, very good data to build a very, very good artificial intelligence. And so the way that we were gathering data, which was core to the business and would continue to run even after we'd built the AI, is by running live in-person sessions for 12 people at a time within a business environment. And so we would be in a co-working space or in specific businesses, and 12 people at a time would come into a room and they would be run through a very, very highly structured session to learn a very specific skill. And those skills are very varied. It's time management and decision-making and communications and communication channels and business strategies and so on. But each one would teach you a specific thing. And those sessions were recorded with a 360-degree camera. And out of those recordings, we actually build the data that is the core of the artificial intelligence. Because of the structure of the sessions, because of the neuroscience behind it, we could very well identify people's state of mind at different points, which allowed us to build our AI. Now, what happened is we had reached a point in our business where we were just getting traction, having enough customers, just starting to get enough people coming into the room on a regular basis, and starting to our revenue was starting to uptick when the news of the pandemic started becoming more real at the end of January. And so immediately what we did is we took stock of the videos that we had. We imagined how long we might have before things started to shut down to run some more sessions in a safe environment. And then we started accelerating our build of the AI. And so the nature of our product, because it was about in-person to begin with, meant that we had to, change the nature of that. So we've sort of pivoted to online sessions, which give us less data, but still good data, and that allow us to build the AI properly. And so the very nature of your product, sometimes in when you're facing some sort of change, like something like this, means that you have to change what you're doing. But like Noble said, it is in the nature of the startup to be able to do that and to be able to respond. And when my co-founder David and I are talking about it, we tend not to talk about it as a pivot. All we've done is we've accelerated one part of our business over another part and changed the nature of what we're attacking first. And it's going to change, you know, the timeline for the money raise, and it's going to change other things because you need a different runway and so on. But essentially, it's the same business, just being rolled out differently. Some people would call that a pivot, some won't. But I think the nature of product is a very, very important factor in deciding whether you want to change or not.
Yeah, great insight, Cauri. And yeah, I agree completely. I mean, we have programs, there are between 4 and 12 weeks. Even during the 12 weeks, our founders are realizing that perhaps the direction they started with isn't working. So they are changing strategy, pivoting during this very early stage. So I agree with, you know, the pivoting, or how we want to call it, it should be natural component.
Iterating.
Exactly. So Mudit.
Yeah.
Would you like to?
Yeah, I mean, you know, I would echo, you know, Scott's and Noble's and Cauri's thought exactly. Like, you know, so for us, we've been looking at it from a bird's eye view perspective, but also looking at, you know, the ground view, as in, so what are the opportunities that are branching out of what we are already doing, and the effect on the business for from the pandemic for us. It's very similar to you know, what Cauri described, which is we were just about getting, you know, initial clients. We were just about seeing an uptick in the revenue, and then the news hit us, and immediately first thing that happened was that the factories have stopped making products that we ship. So even though there are more users playing more games, and chances are that we might sell more merchandise, our factories are not functional. So the first thing we had to do was we had to look for alternative factories, because China, you know, had started to come out of the pandemic by the time India went into a lockdown, and our factories are in India, and our pilot customers are also in India, actually, so immediately we started looking for factories in China, but the logistics is still not working in India. So what are the immediate next things that we can look at? And one of the things is that we could look at focusing only on the US and European clients, and only ship product to gaming company, ship product in US and in Europe. So so a shift in the market is one way to, I mean, I don't know if you would call it a pivot. It's almost like, again, it's like a branching opportunity out of what we were already doing. And the other thing is that somebody I know requested if we could make, you know, face masks, 3D print face masks. And because we have those relationships with factories, you know, so the factories are also happy to help us make those face masks, and they can make them because the government stipulation is that if it's something that's related with the healthcare and pandemic, then it's okay. Then factories can be functional. So these are some like branching opportunities that came out of that. And I think the biggest concern for us at the moment is if we decide to go for a hard fork, a hard pivot, and do we have enough cash in the bank to execute on that product and to get it to market, because we already had a product market fit. And but at the same time, how do we keep the cash flowing, and how do we keep the processes and the business going? Because if things go into a standstill, then it takes time to bring them back. It takes time to get things operational again if they move into a stagnant sort of situation. So in terms of the team working and the operations working, so yeah. So there's a bird's eye view perspective, which is like, what's the balance sheet like? What's the amount of what would the cost be of executing that pivot, and then there's a ground view as to what is the easiest to execute, right? And then like it's been about basically looking at both those situations and doing whatever is practical.
I agree. I'd like to add that it's interesting that I mean, all startups are really looking at continuously adapting to opportunity and trying to balance that out with focus, because we're constantly looking to see, oh, is there a better product market fit? Is there a greater opportunity in this industry over that vertical over there? Are there better ways of accelerating our business in different places? And at the same time, for example, you'll know this from the investor side, when you talk to investors, every investor will tell you, oh, you should be over here, or you should be doing it like this, and pushing you. And so you have all these things that are pushing you around to adjust your business all the time. And you're constantly we're always trying to find, do we do that, take that opportunity, or do we keep our focus where we are? And do we have enough burn rate to run us through to what we think is the ultimate outcome? And so in a way, the pandemic is just another one of these impetuses, right? It's just another thing that's pushing you in a direction, and you have to decide, do I have enough money is that a good opportunity for me? And do I have enough money if I want to go the opposite way? And so to me, the pandemic is not unique in that way. It's unique in the world because it doesn't happen very often. But in terms of just being an impetus for change, it's just another one amongst many.
Yeah.
Yeah, let's say, so in a way, it's like founders are always in a pandemic situation. I mean, with all every week there is an emergency in a startup.
That'll be the quote of the day,
and that is 100% the reality of the situation. That either you don't have enough money, or you have too many ideas, or your suppliers have changed, or whatever the case may be. Exactly. This is something that we're dealing with on a constant basis. It's unfortunate Mudit had the issue with India versus China, but the reality is it could have happened even in a non-pandemic scenario, where you have to change, or the tooling is different, or whatever the case may be. So it's just the ability to be nimble and to think on your feet and realize, like, Cauri said it best. He goes, look, we had it already in our business plan. We just actually inverted the order. And, sometimes that's what's required, that it's already there, but you have to change your approach and change what you have to do in order to be successful. And some of the best things, that's the old classic turning lemons into lemonade. So some of the best innovations happen in a time like this.
Yeah, I think resistance to change is the biggest killer for most startups. And the idea that you'll have a lot of founders who come along who have a really good, solid idea, but they're so wed to it that even when everything points in a different direction, they want to stick with that one thing. That's a death knell. And I think that's why investors invest in people all the time. And I know it's a cliche, but they invest in the ability of the people to be able to respond to the environment quickly, rather than just investing in an idea, because frankly, ideas are fickle and change all the time and are subject to so many other exterior forces that what's important is the ability of the people involved to actually change depending on those external forces, rather than the value purely of the idea itself.
But just to add to that, I think conviction is key, right? That the founders have to have the conviction of their business and the decision that the business is, at the end of the day, not something they're willing to abandon. And because of that, they're willing to make those necessary changes and pivots. I think sometimes, it's very difficult being an ideologue in a startup format. You can't keep trying to make squares when everyone wants circles. But if you have a conviction that you can make the right type of circle and it makes sense, then that's where you step into place. And Scott deals with it all the time when you're dealing with founders. If founders come across as overly static in their mindset, then there's no way to get any deals done, because we're in a deal-making environment. Everything has to be fluid.
Oh yeah, no, that's 100% true. I mean, we've passed on deals before where the foundation of the business model, or the idea or platform, if you will, were very solid, but the founder was just kind of stone-headed, for lack of a better phrase, and it was his way or the highway at all times. And you could tell it's difficult for those people to really succeed because if opportunity does arise and they've got particular amount of capital left on their balance sheet and they can choose to pursue it or not, then they're dead in the water if they choose not to. It's just the reality of the situation.
Yeah.
Yeah.
Being nimble is just so key being a founder. You know, you have to be psychologically as well as physically, and being able to stretch the balance sheet and then being willing to ask for more money when you don't, when you hate having to ask, but knowing you need to before things are bad. You have some foresight on the horizon.
I would say that that's actually on that point that when something like a pandemic or any other external force comes into play, like reassessing your business and your balance sheet specifically to determine as early as possible that this is the time to ask for more money. This is the time to go back out into the market or to extend the round you're in so that you can bring in a little bit more money in that round at better terms for your investors, or like all of those decisions, I think are the earlier you address them is the better off that you can weather any storm that comes. I think one of the things that happens sometimes with founders is they overestimate what they can get done and how they can respond, or we do, because I have been on both sides, both an investor and a founder, and you tend to push it till you've got like 3 weeks of runway left, right? And they go, okay, I need to go back to my investors, and the investors like, I don't know, and you're putting them under pressure, and then there's a dynamic that doesn't necessarily play out very well. And so like the earlier you can identify and look at that, like Scott said, look at your numbers and realistically look at where they're going to go. Going back to the well for money is a big part of dealing with any kind of big pivot.
Cauri.
Yeah, and to build off that as well, just as a piece of advice there too. I particularly see this a lot of times in seed stage companies and even earlier Series A stage companies as well. They kind of set their budget and they forget about it, or their operating model and they forget about it, and they check in maybe at the end of the month, if even that frequently. More than likely, it's probably quarterly. Whereas now in these types of kind of black swan events, you really have to keep an eye on those metrics weekly and those models weekly. Because as Cauri said there, if you're looking at your run rate and you've got 4 weeks to 3 months left, you just don't have enough room there. Because you need to really give yourself that lead time from, hey, I need capital today, but realistically, I really need to bridge this gap over 6 months. Because you're going to run into a lot of your investors now, their liquidity is frozen, if you will. They're maintaining their current portfolios and what's working, and they're not really allocating to riskier investments. And the reality of the matter is venture capital is very risky. So you have to give yourself that amount of time.
So Scott, this is the current situation that you see in your community, investor community?
Oh yes, very much so. I mean, you've got companies that were seeded; they've got great ideas. They're just getting customer traction, but they're coming hat in hand, too little, too late. I mean, if you've got 2 months left on your balance sheet in terms of burn, I hate to say it, more than likely you're done.
But we had an interesting technique that we've been using, which is advising startups to do this, is when we created our P&L and our 3-year projections about what we thought the business was going to do, that sort of became our baseline document. And then on a weekly basis, that gets updated, right? We have a version of it which gets updated with the real figures. And so we get to see a divergence from what we projected to what we're actually doing continuously on a weekly basis. And it really helps inform, because all of the formulas ahead are all formulaic. And so as you make those adjustments, it adjusts your future. And you can then see comparatively, well, this is what we planned. This is what the new projections look like. How do those compare? And what activities what actions can we take change that, reduce costs, introduce a new revenue stream, reduce churn, whatever it takes to move those metrics where you need them to be. And I would say having somebody looking at that on a daily basis is really important in early stages. And then in terms of our whole team, we look at it on a bi-weekly basis, and then us as co-founders, we look at it every week or every 3 or 4 days, just to sort of keep our heads above water and know exactly what's coming. And that's really served us well in this particular scenario, because it meant that very early on we could see exactly where things were going. I would advise that for any.
And that's a great practice to follow, no matter what the current economic environment looks like. I mean, something that you could probably, as a first-time founder, a young founder, fall back on now is really lean on the resources at your disposal that are non-monetary. Go to your board of directors or any advisors that you have that are close to your business. People nowadays have nothing but time on your hand. You're stuck inside. Go to those mentors and advisors and board of directors. Call weekly meetings, call daily meetings, because they're going to be your best resource from a non-monetary standpoint to help you get through this. And it can even be something as simple as having a discussion as, do we pivot away from what we're doing now into a new opportunity that we've identified.
I think also, though, too, is a lot of founders, I think early on, they get, especially in the seed and pre-seed rounds, they get happy that they got some funding, and then they stop looking for funding. And that's one of the worst things that you can do. The reality is that you are selling your business and you're selling your widget. And it has to be done concurrently. I tell people all the time, you have to run and tie your shoes in this particular marathon. And if you don't do both simultaneously, you find yourself really left holding the bag, because in the early stages, and I say even after Series A, you can't sell enough widgets to run the company and expand and cover payroll and to create new opportunities. You just can't, no matter how much revenue you're bringing in. You know, people always forget, they talk about Amazon being a darling, but for over 11 years, they were operating net negative because they were constantly reinvesting back into infrastructure. And all of that investment was constantly being funded with bonds and outside investment money for it to grow. And then finally, after over 11 years, they started to really decide to pull in cash and generate a profit. So if the largest companies that we admire operated that way, then too many startups, and I do believe that bootstrapping can work. So don't get me wrong. I mean, some people bootstrap and are highly successful at it. But at the same time, for every one that's successful, there's a dozen that just can't be. And sometimes it's just time. You know, you need enough.
A dozen is generous. I mean, 95.
Yeah. Well, you know, there you go. Well, that's what I was going with, right? When right? Succeed. But my whole point is that, you know, so many of them are so fixated that they, like you said in a moment ago, the founder really overestimates their capabilities and the love and success of their product. And they just don't have enough traction. And it doesn't mean it's a bad idea. As Scott was saying a moment ago, it doesn't mean it's a bad idea. But if you've already stopped raising money at some point, then how do you weather these black swan events, or how do you even weather a supply chain, or in small things? And too many founders early on, because they don't like raising capital, get excited because they've gotten the capital and they've really stopped doing the fundamental thing that got them to where they are. And fundamentally, startups have to be in a consistent drive to raise capital. Even during this time, we'd be frank with you, you know, we've consulted people. This is probably one of the best times for the accredited investment set compared to the VC set. Whereas the accredited investors are really looking to get away from the markets and trying to find their outlier opportunity during these dark ages. Family offices and some of the larger LPs are doing the opposite. They're kind of holding. So you have both the street and you have the institutional who are operating on two different impetuses. And if you as a founder have to pivot, then you have to pivot to where the money is.
And Cauri, I guess you also you're running a fundraise, right? What's your experience right now, right? If I'm not wrong, are you finding? I mean, what's from your point of view? How would you describe this experience of going through a fundraise during the pandemic?
Actually, it's no different from doing a fundraise outside of a pandemic. The only difference is that it's more video calls and phone calls than it is in-person meetings. But it's still, the numbers are still the same. 100 outreach leads to 10 meetings, which leads to one possible investor, right? And so those metrics are no different now than they were before. Thankfully, we have a great business development person who reaches out to nigh on 1,000 people every day. And so those numbers, the more you do, the more those metrics play out. And that's, some people prefer to go the other route, which is find very specific investor groups and go after very specific and so on. And that makes a lot of sense for some businesses. But fundraising is pretty much the same thing. We've come across some really interesting things in doing the fundraise right now, where there are people who have online assessment tools, which for investment groups, which is really taking off as a technology sector, right? Which they've white labeled them so that you can actually funnel through a lot more people a lot faster. And so investors, it's been interesting coming across a couple of those run by artificial intelligence and other methodologies for sort of cutting through all of the different people looking for funding. But the fact is, investors' money, if it's in a bank, it's wasted, right? It needs to be invested. And so investors need to invest, and they're dying to invest just as much now as they ever were before. The only difference is you becoming the person that they want to invest in, right? Making sure that you have the right product and the right team to make it happen. But I see no difference now, really, and no material difference between before the pandemic and now.
Interesting feedback. I mean, perhaps it could be inspiring to all of the other guys that are really scared right now. And
but I think that's Cauri. I think that's because Cauri just has got enough season under his belt. I think for the full people who just start up, they don't realize to continue to persist. And then that's really, I think that's really the core of it. That it's a numbers game.
Mm-hmm.
Mudit, you are about to start a fundraise, I believe. Did you have any feedback, any first perception?
I mean, yeah, there's certainly a concern that, would the numbers be the same, like what Cauri is saying, if you reach out to 100, then you get 10 meetings. And then, so there's that concern that, have those numbers changed? Do I need to do much more to get the money in? But again, I can't really comment on that. Hopefully they haven't. And so, but hard work pays off. So if it's not 100, it's 200. If it's 300, whatever it is, we'll do the hard work and we'll get the money in.
Great.
All I can tell you, Mudit, is that at the moment those numbers look to be pretty solid, right? From what I'm experiencing. So,
Scott, what do you see from your point of view? You're working probably usually a slightly later stage compared to these two companies, but can you offer your point of view?
Yeah, so from a private equity and investment banking standpoint, what I'm seeing is a lot of high net worth individuals and accredited investors and even fund of funds. They're shifting their capital allocation strategy away from growth investments more towards yield. So that has become a very popular asset class, and anything with like a preferred equity instrument with some sort of kicker on the back end, a dividend payment that can be cumulative over time, that might be a strategy that a lot of these founders need to shift towards. Giving up, quite frankly, a little bit of the valuation as well to secure a safety net in terms of closing the round faster. I have always subscribed to the notion that you raise as much capital as you can while you can, and right now it's going to be a pivotal time for a lot of these young founders and early stage startups that don't have as secure of a balance sheet to really close on capital quickly. So they have to get a little bit more lenient, is what I'm seeing in the market right now.
And Scott, when do the investors actually ask for that? Ask that of the founders, or are you expecting the founders to shift an offer, or
Oh yeah, I mean, it really depends. If they've landed a lead investment, say like 6 weeks ago, that valuation is pretty much set for the most part, which can honestly be a death kiss in and of itself. If the market views the valuation as too high, their round might be over. Other than that, I mean, if I'm in the shoes of a founder standpoint, I'm coming in saying I'm open to valuation as long as it makes sense. I'm putting the onus on the investor to set the terms and set the valuation. And if it's something so egregious, my advice is push back, make them lay out their logic of what they're seeing and why. But yeah, it's getting to the point now where a lot of accredited and funds are starting to get much more aggressive in terms of lowering valuations and rounds.
Interesting. Thank you.
Interesting. And I guess Noble, I think I gave you already the opportunity to show your point of view, right, on the current situation with investors and what is it the same numbers as Cauri as suggesting, or?
Yeah, well, I mean, like I said, we go to, there's $9 trillion sitting in self-directed and IRAs out there. And with the impact, since we're dealing directly with individual accredited investors, the numbers have always played the same, but they've always been, the same. Our teams, they call between 800 and 1,200 accredited investors, and they get 2 to 4 qualified leads daily. It spiked a little bit during this period because more people are accessible, but it's always been the same. When I started off as a broker and I got my first stack of leads, we had to call 200 to 300 people every day, and to get 1 to 5 packages out for investors. So within 2 weeks you get your first check, but you got to be diligent, right, in order to do it. So it's the same. Nothing's really changed in how it functions. I think that because of the way the stay-at-home orders are operating and more people are not out and about and their schedule's a little bit different, I believe that our teams have been a lot more successful actually in reaching direct investors than they may have been just even a month ago, which allows us to put out more packages and do a lot more. But the numbers are the numbers. That's the crazy part. It's just the law of averages have always worked in anyone's favor to do it. And so if you've got a good IR team, investor relations or business development team, that is their focus and they understand your project, you're going to do super well. I mean, so numbers.
I always feel like I love that. The numbers are the numbers, but it doesn't mean that there isn't something more to it, in that it's like, we always think that from a founder's point of view, founders and investors is like a marriage, right? You're trying to find the right person to be with. And so the numbers doesn't mean that you're just going for anybody you can get. It still means it just increases the number of people that you meet that might be the right match. And so, and therefore might go all the way. Yeah. And that's really what you're looking for, right? And,
no, it's one of those things where you are actively creating your luck, right? To find your guy. We always said it in the brokerage when I was building my hedge fund up. You're just trying to find your guy. That is just because someone says no now doesn't mean no forever. Is number one, and then number two, that person just may not be your person. Someone call them up tomorrow, and that same person will invest $1 million in their startup, who just for whatever reason didn't like the way your tone was, or didn't like the idea, or just really didn't believe in your idea, but for whatever reason he believes saving the koala bears is a lot more lucrative. You just don't know, but the reality is you have to have more than enough times at bat, and by talking to enough people who expressed an initial interest, you create your own luck, right? So 99%, what is it, 99% inspiration, 1% inspiration, so that's luck. So the reality is that's really what it is. You just got to continuously get back.
Agreed.
I agree. Hanad, did you have a question? I know you've been researching and reading some more articles about what is happening in the startup community. Some interesting pivots. I mean, the other weeks I read about even Ferrari and Tesla creating respirators for hospitals, doing this kind of promotion, but also small changes, adjustments in their production. Did you have a questions for our guests?
Yeah. So Mark Cuban described this COVID-19 situation as something of a reset, and advised that if an individual has a vision for their role in America 2.0, they have to test it now and get feedback. And even for startups, it's time to start thinking about a pivot. But what can a startup do if their current model doesn't work, under COVID-19, but they don't see a way to pivot? Like, what are some things they can start to think about that might help in finding some plausible directions to pivot to?
I can suggest a couple of things. I mean, it depends so much on who they are and what they're doing and their own capabilities. But I would say that one of the main things is kind of what Noble was talking about at the beginning, is looking at the trends, like really looking at the trends. And these are broad scientific trends, sociological trends, political trends, all of the trends and the different trend sets and the sub-trends inside of there, to see if you can find anything that resonates with your skill set, your team's abilities, or with the product that you've already built in any way, so that you can then take advantage of that. To me, that's your biggest lead in. If you're looking for a brand new place to be, and that place is not in the job line or in the unemployment line, then looking at the trends in the world is where you need to start to figure out where you're going to fit.
Right. Yeah. And I can even provide a kind of real world use case that we're seeing within one of our own portfolio companies right now. We have this portfolio company that's 2 years ago launched as a data pricing and aggregation tool for consumer staple products that you buy in grocery stores, pharmacies, etc. Their primary business model was, we need to provide location and pricing data to consumers to allow them to make the best budget choice for their household. Now that they've seen the trend kind of shift into, okay, people are uncomfortable or don't feel safe walking into major big box stores, and people are starting to shift towards things like Instacart, Amazon Go, Amazon Prime delivery for fresh food. They've decided to kind of pivot into, hey, we already have this great pricing data tool. Now all we have to do is integrate through EDI and APIs into the big box retail stores inventory system, similar to an Instacart, and basically pair those two things together. Now, the way that they made that decision is they saw the spiking in unemployment start to increase and exponentially grow week over week. And so once they saw that trend started emerging, they started to notice delivery might not be the number one option that people are going to go after, because delivery costs takes resources away from individual family budgets. So what they're doing now is they're shifting more towards pickup options. So as American households and consumers become more budget conscious, they're still looking for that safer alternative, walking and perusing the aisles, but they need a more budget friendly option than an Instacart or an Amazon Fresh or a Prime delivery. So just keeping an eye open for those types of opportunities that are going to come about. You can test those things early on to an extent, but a lot of it is just putting a full foot or both feet into the water, so to speak, and really committing to it.
So a good example is right now, and I don't know if anybody read in the news, a lot of the major meat co-packers are having trouble keeping their employees because of the COVID-19. And so the expectation on near horizon, is in the next quarter, there's going to be a shortage in different processed meats, particularly hogs and cattle. But what's interesting is that there are a lot of local farms that have had delivery services that were fully grass-fed, that were marginalized. And one of the things that we've been looking at is we've reached out to several Oregon Valley Ranch, we've reached out to Sunrise Ranch to help find them more capital to do their marketing to increase their local delivery, because all these guys, and again, just full disclosure, I've been a customer of Sunrise Ranch for almost 3 years now, because we eat grass fed and the like, and it's kind of cool having it delivered and not have to worry about going to the grocery store. So it's something that was already on my personal radar. But as this has started to become more of an issue of food security, I believe that some of the things that they offer, like neighborhoods and families being able to buy a whole cattle that they own, which is broken down, these things that they have full direct access to food for people locally, also decreases how much you pay per pound on average for everything as well. So, we're reaching out to them to figure out how much more capital they need to expand their marketing and what we can do to help with their SEO, because most people would like to buy local. And if there is a shortage, how do you give people just one of the basic staples, which is, just meat products? So there's so much. The news, if you're really paying attention to what's happening in the news cycles and you're really paying attention to where growth is, then you're going to be okay to pivot out of whatever you're doing. But I think the first step that you have to say is that you're wrong. And it's one of the toughest things that a founder may not want to say before. They realize the writing's on the wall. They probably had a project for movie theaters, and realistically, movie theaters are never going to come back the same way they were. So now they have this project that was going to be one of the next best things to sliced bread. It was all revolving around movie theaters. Now that movie theaters are not going to be the place to be, can you really admit that you're wrong? And oftentimes, and Scott alluded to it, Cauri alluded to it, oftentimes if you're an inflexible founder and your ego is driving the whole bus, then there's no way for you to just make that simple decision to say, we're wrong, go back to your investors and say, we have to pivot the capital. Like sometimes it's just a requirement that you have to pivot the capital, and will you guys go this other direction with us? Mudit said, look, we realized what part of our issues were, and we found out that our supplier could provide masks. That's a huge pivot from selling items directly into video games that are bought digitally, they're physically delivered. But it's a pivot that was on the wall. He had the resources. So you just have to be psychologically capable as a founder. And sometimes it's hard to just kind of, you're in your baby. So I just think that mentally, everyone's got to be prepared for the change.
Right. And another thing to add on to that as well, Hanan, I think that if you haven't launched your product already, you should also probably consider subscribing to the Reid Hoffman methodology of, if you're not embarrassed by your first release, you've launched too late. And I think that in this current environment, you'll probably see a lot of MVPs rapidly accelerated because of they do want to test the hypothesis now, not only A, because liquidity and capital is starting to dry up, but B, there's all these new opportunities for market share to be garnered and captured. So you'll probably see a lot more rawness behind technology and platforms that are being put out into the marketplace. So
absolutely,
I think in terms of an entrepreneur, if I'm looking at that, that's exactly the mindset that I'm taking. I'm accelerating my launch up to the literal bare bones that I can to get the MVP out into the market.
Yep.
That's great. That's great. I mean, that's somehow really resonate with at the earlier stage level. We do at the Accelerator with our lead coach Scott Hindle. We really try to go through these loops. Of course, at the strategy and the training level, not necessarily at the operational level yet for our participants. That so that we infuse this transition mindset that essentially we've been talking about over the last hour. I just would like to have a last round and kind of a suggestion, your point of view, even if it's a repetition, but just to sum it up for our viewers, for our current audience, and for the ones that are gonna watch again the videos. It's gonna stay on the social media for a while. So Noble, would you like to start?
Yeah, I think that if I were just to reiterate, and it's awesome being on a panel with everybody. It's great having everyone's point of views from multiple multiple levels, from both founder to investor and to be entrenched. So it's really cool when you're talking to people who've been on both sides of the fence and we're all communicating. And I think that the core of it, particularly now, if I were to just leave one imparting message, is that really believe in yourself. That's really what you have to do now. Scott said it. You got to put out a raw MVP. Cauri says you got to continue to make calls and reach out. Mudit says, look, we've pivoted in our side of our business already on 2 different occasions. You have to believe in yourself and believe that as a founder and as a startup, that what you're going to do may not be right, but is right for right now. And you have to make those actions that are going to lead to your success. And you got to work past the fear. Nobody's never going to have fear, but courage is right. Not the absence of fear, but the bravery to continue forward in spite of the fear. And I think that's really psychologically where I've been and where I kind of encourage all my clients to be, that we need to continue to walk through the door. So that's really it. Just continue to believe in yourself as a founder, and then rely, as Scott said earlier, on all the resources, intellectual resources that you have to be successful.
Thank you, Noble. Scott, would you like to take the word?
Just to reiterate again, cash is the lifeblood of any startup. So really keeping your finger on the pulse of your cash flow and your burn rate is going to be vital within the coming months, and to really keep a very close eye not only on your internal metrics, but as Cauri and Noble and Moody have all pointed to, really keep an eye on the economic landscape in terms of they're very easily, there's going to be hundreds of thousands of opportunities out there in the world today for you to pivot and capture some market share that other people just they have a blind eye to, or B, they're just ignorant to the opportunity because they're not keeping a pulse on it. So really keep an eye on your metrics and the landscape around you.
Thank you, Scott. Mudit, did you have a final suggestion or a recommendation to our founders?
Yeah, I think one thing I'd like to point out is that as founders, we kind of thrive on tough situations and difficult problems. But in a situation like this, maybe it doesn't hurt to look at what opportunities are in front of you, which you can go after with least amount of friction and with least amount of difficulty, and also look for these opportunities in the immediate relationships that you have, and basically just like connect the dots and make it happen. But yeah, I think instinct of a founder is to thrive on difficulty, which maybe in times like these, you may want to just go for things that are easier to do and that you can make progress with at a fast pace. So yeah.
Cauri, thank you, Mudit.
So I think that there are different sizes of pivots. So there's the smaller things, which I would call them iterating rather than pivoting, where you're making small changes in response to things that are happening around you, things you're learning, new hypotheses that you're testing, and so on. And so you iterate against it. And then there are pivots, which are a big change in your organization, where you're moving to a new category, a new product, a new supply chain, a new market. And so those are much bigger changes that you make. So my counsel would be iterate constantly and pivot cautiously. Right? If you're going to make one of those big changes, knowledge is your best friend. Do a lot of research, spend a lot of time thinking it through, not too much time, but think it through and really get to know what you're pivoting into before you make that decision and pull the trigger on it. But once you pull the trigger, go for it.
And with that, thank you, Cauri. I really thank you, everybody. I really thank everybody in the panel, our investors, our founder, Hanad also. And with this, I'm going to close our live stream.
Thank you.